we want to be agnostic to market noise and timing, and really the best way to win this game investing in the market is just to stay invested in the long term. I would generally say just be invested over at least one market cycle. I think on average is about 7 years. But again, just try to, every client situation is different, but when you are invested in the market, just I would just expect to have that money there for the long term.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, the king of data, Andrew Pratt. Welcome back, Andrew.
Good morning, Casey.
So today we're going to talk about index funds. I love this conversation. I used to do it, talk about this a lot when we started the podcast. It's been a while. I can't remember what the last episode was that we really dug into index funds, but I think this is an important conversation for all the listeners to understand what indexing is and the different vehicles that we can use to do indexing, ETFs versus mutual funds, all that fun stuff. I think it educates our listeners to kind of know what to be looking for in portfolios. Right. So even if you're not a Wiser client, you can go, hey, I have a lot of these things in here that maybe I shouldn't have. But anyway, let's, Wiser has always been somewhat leading edge when it comes to investing. We were one of the first firms to start using all index funds in 2004. We were named one of the top 25 pioneers in the usage of ETFs back in 07-ish era, which is a long time ago now. But
Casey's a visionary.
Yeah, right. Probably one of the first firms to start adopting the Bitcoin ETF into its portfolios. Not the first. I wasn't willing to be the first, but certainly
there's not many out there. That's for sure.
Yeah, correct. So you have to be doing that as a firm. You have to be always researching the newest, latest, greatest things, and 90% of them are stuff that you don't want to participate in. But occasionally something good comes up, and right? We should be doing that. This is what's best for the client. So let's get it started. What is a indexed fund? When people say I'm investing in an index fund, what does that mean?
So an index fund, there are indexes, which is a basket of securities. It could be stocks, bonds, or a combination of other types of securities. And you cannot invest in an index directly. So there are funds out there, they could be ETFs or mutual funds that are comprised of these underlying securities that track this index's performance and also risk, just so that they are mirroring those returns, in both up and down markets.
So an index would be, I guess, for the people at home, the S&P 500 is what gets reported, to the Dow. No one really invests in the Dow anymore, but
no, not really.
The Dow gets reported.
That's like your grandpa's index fund.
Right, exactly. It could be the NASDAQ. That's an index.
Right.
It could be the U.S. bond aggregate, which is all the bonds in the U.S. Are a representation of those. So what's interesting is index funds, there's so many of them, and in some cases, they created the index and then they created the fund that tracks the index.
Right.
But the old passive ETFs or mutual funds, those are tracking indexes that most of us would probably recognize.
Right.
Vanguard, for example, may not track the S&P 500 all the time. It may have its own index that it's created to replicate.
Yeah. And that's where you really, when you're investing, you should really, read the prospectus, especially if you can't sleep at night. Right. These are sort of long and dry, but there are different types of indexes, and some are track similar exposures. And what I mean by that, just say, for instance, like the S&P 500 is large cap US equities, but there's the different indexes out there, like the Russell 1000, which is also large cap US equities. So you just really should know what you're investing in, and a fund's prospectus is a good way to learn that information.
Yeah, not to dive into the weeds this early, but what I always have learned from the very beginning was the index methodology is very important. You have to understand how the stocks got into the fund. And once you understand how the stocks got into the fund, then you'll understand how that index fund would be reacting to different scenarios.
Yeah. And, to your point, there's most of them, I think, are market capitalization weighted, which is basically the highest market caps get, the higher weights.
Right.
But there are some that are price weighted, like the Dow, and it's just different construction methodologies with different indexes.
So even the index itself could have some active selection. So for example, the S&P 500 has a board, and that board decides who's coming on and who's coming off the index.
Right.
So, and they have a selection criteria that you have to meet. So one good example, modern day example, would be like Tesla. Tesla was not in the S&P 500 for a while, but it was in the Vanguard Large Cap Fund.
Right.
So Vanguard Large Cap outpaced the S&P by 2% the year that Tesla was really growing, but could not be included in the S&P because it wasn't profitable yet.
Right.
So those are just little things that you have to pick up on to understand why different indexes perform different ways. But I think the point here is that indexes replicate, or index funds replicate the indexes themselves. So let's talk a little bit about ETFs now. So you have an index mutual fund and you have an index ETF. What are the differences?
So the differences are, there's a few differences. I'd say probably one of the biggest differences is the cost. Index mutual funds are typically, they're still pretty low cost, but usually the ETFs are a lot, even at a lower cost. And then also I would say the tax treatment. ETFs in general are more tax efficient because generally they don't pay out capital gains distributions just based on their process of creating and redeeming shares between the fund and the broker or the sponsor.
Yeah.
And mutual funds, the share creation and redemption process is between the investors and the fund. So there's usually capital gains that are paid out to all the shareholders in this process. So, overall, ETFs are more tax efficient because they don't pay out these potential capital gain distributions. You still have to pay capital gains if you go to sell as an investor. If you go to sell the fund, and it's at a gain, you'd still pay the capital gains distributions, but there's not those extra, capital gains distributions that you might receive.
Yeah. So, in an IRA or a 401k, doesn't matter that much really,
right.
From the tax efficiency standpoint, but it does matter a lot in a brokerage account. So a lot of times we'll see these legacy mutual funds that come from other firms that are probably larger than us, but they just have an older management style because typically the people running it are in their 60s and this is what they've always known and done. And what they're doing is you never, let's say you never made a transaction, you get this 1099 at the end of the year, it has all these capital gains on it. Even in a year like 2022, when the market was down, these mutual funds were issuing taxable gains.
And I would say a lot of times that you do see that in down markets is because you'll have other shareholders in mutual funds selling their shares, to raise cash or liquidity or whatever. And, then the fund will have to, sell at a gain and pay those gains out to the other shareholders.
Where you wouldn't have that with ETFs.
Right.
So the larger your portfolio is, the more negative tax implications you're going to have from owning those mutual funds. And more importantly, they all come in the last minute in December.
Yeah.
So it's not even something you can track. It just all kind of kicks in the last month, which is why you never want to buy a mutual fund near the end of the year. You would want to wait until after the capital gains have been paid out and issued. So something else I want to talk about is, we were talking about passive funds. So, and replicating an index. So you have mutual funds that replicate the index, and you now have the ETF that replicates the index. But we know that this is a more modern index fund. You do own the underlying assets. That's important. Right. So the ETF owns the underlying assets. Mutual funds, you own the underlying assets, right?
Right.
So those are the same. You're not, ETFs are not more risky than owning a mutual fund. There is still information on Dave Ramsey's website stating that mutual funds are basically derivatives and no one should ever trade them.
Oh gosh.
The year is 2024.
Wow.
And that man still doesn't understand what an ETF is. I love him. He has gotten so many people out of debt. He's gotten so many people headed down responsible use of money. But when it comes to investing, I don't understand him.
He's very anti-crypto too, which I know there's a lot of skeptics out there, but yeah, I think he's kind of stuck in some ways. But
literally there on his website, it is factually wrong as to what an ETF is. And so I can only guess that the people surrounding him just don't have a clue.
Right.
other than the envelope system. They got that down pretty good. But the ETF is not a derivative. There were times in the market where the ETF can trade more efficiently. And that's my next point, than maybe the individual stock or asset class would, but an ETF trades throughout the day.
Right.
So when the market opens at 9, when it closes at 4, roughly, that's not exactly how it works. We won't get into the weeds, but from 9 to 4, you can go trade an ETF. Where a mutual fund, you can place a trade, but it doesn't really settle until the close of market.
Right.
So you always get the end of day price. Where an ETF, you can trade throughout the day. Now, it doesn't mean it's supposed to be a day trading instrument. It just means that you can liquidate it or purchase it more efficiently than what you could in a mutual fund. That's all that means. Now, in ETF world, this is where I wish that we have done something a little more European, and that is we should have called them ETPs, ETP, exchange traded products. Because ETFs can mean so many things. Right. ETF is the wrapper. It's like saying, I have a car.
It's kind of the American lazy way.
Yes, I have a car. I didn't tell you if it was what kind of car it was. Or you could even say, I have a vehicle. It could be a truck. It could be a regular car. It could be a lot of things. It could be an ATV. Who knows? So in ETF world, there's active ETFs. So these are ones that have managers. They're trading every single day, and inside that account, some of them will tell you what they've done almost instantly, and some of them you have to wait till the end of the quarter, some at the end of the month, right? But there's active ETFs, and then there's the passive ETFs.
Right.
So you have to know what you're investing in. A lot of times the price will tell you. If it's 15 basis points or less, it's probably more passive. If it's 0.15 or greater, or I'd say 0.5% or greater, it's probably more on the active side.
Yeah. And so, there are active ETFs, and again, they kind of run the gamut. There's active ETFs that are tracking like benchmarks, that's similar to index, but you have like your US sectors, like communications, technology. There's, I'd say that's more like a benchmark, and it's not like a total market index. So those are pretty low cost still, but then you have, active ETFs that are, really deep fundamental, very concentrated portfolios that are very, they are higher cost because, there's that management overlay there. Yeah. But then there's some that are very systematic, rules-based processes that, like you said, it could be like 0.2% or less.
Right. Yeah. So that's an important thing to understand. And then there's also ETFs. So there's 1933 Act ETFs and 1940 Act ETFs. Now the 1940 Act ETFs are the ones you don't own the underlying assets. These would be like inverse funds. So you do NASDAQ times 3, leverage ETFs. You don't actually own the underlying asset. If that company goes out of business, you end up with a zero.
Right.
Yeah. And then there's also ETNs, which are exchange traded notes that replicate an index, but again, you don't own anything.
Right.
So when Lehman Brothers went out of business in 2008, there were about 3 ETFs that went to zero, basically, because the bank was now gone.
Yeah, right? I think there was one a couple years ago, maybe like 5 years ago. There was an inverse volatility index ETF that went bust in like a matter of a day or two.
Yeah. So you have to be careful that you're purchasing an ETF, that you own the underlying assets, or you have to understand the risk. And this is the problem. Even in 2009, I remember walking around at the ETF conference down in Florida, and people were like, "Oh my gosh, I bought this inverse S&P or large cap ETF, and so the market's down 60%. I should be up 120%."
Right.
Well, I knew that that's not how it worked because it's leverage and it resets daily. So our up days were bigger than all of our down days. It was death by 1,000 paper cuts. Market was down 500. Then it was up 2,000, down 500, down 500. So when you go back and back test that, you still lost 20% because, you is how the leverage gets reset on a daily basis. So inverse funds are supposed to be bought the beginning of the market, it closed at the end. And yeah, I've done many blogs about this, and it's funny how people will write comments and challenge me on that. And a lot of
Really?
times, yeah,
Wow.
I just go swipe delete. I'm not going to respond to that. It's
Interesting.
read the prospectus,
Yeah.
open up the prospectus and read it. And it tells you right in there. It's
Right.
plain as day. So anyway, typically, other than, commodities. So commodities is not something that you maybe don't want to own directly, because if you screw up, you're going to have cows delivered to your backyard or oil delivered to your doorstep. So typically those would be ETNs, and you're buying the replicating what's happening in the commodity space. But outside of that, I think that most people just want to buy ETFs that are more on the passive side.
Right.
As we're focusing. But anyway, so let's get into the benefits, which I think we've maybe covered some of these, the benefits of using index funds, specifically the ETFs.
Yeah, I would say, index funds are very diversified. For instance, like the S&P 500, 500-ish stocks. So you're I almost say ultra diversified in that sense. Some of these active funds are very concentrated portfolios and can have 30 names or less. So your market risk is diversified away in these index funds. And then, we've talked about costs already. Generally they're low cost. I think our S&P 500 ETF is 2 basis points, maybe 3 basis points.
Which is 0.03%.
Yeah. So very, very cheap to get that high quality market exposure. And then, again, it's just kind of a good hands-off way to get dependable returns. We're all kind of familiar with S&P 500. We understand the risk, for the most part, what we're getting into. But when we put our money into these funds, we know generally what it's going to do. I'm really talking about the people that are not looking at this on a day-to-day basis. So it's kind of dependable, consistent returns. It's very simple for the most part, fairly easy to understand. And then, again, just kind of a hands-off approach. You don't need to be day trading or trying to time different market exposures to, get that return. I think since 1930, the S&P 500's averaged over 8% annualized return. So that's what you're investing in when you put money to work there.
As far as disadvantages, I think honestly there really are none, unless you want to be more active with your strategy. But even then, there's index funds that replicate the airline sector, the energy sector, the tech sector. So there's so many different ways you can handle this. But I guess tracking error, if you're not with so we talk about the cost. So an ETF that has a low cost of 0.03%, if it's coming from a provider that doesn't have a whole lot of volume, meaning that the ETF doesn't trade a whole lot, then you're going to have a bid-ask spread that could get pretty big.
Right.
So for example, I love Wisdom Tree products, the ideas that they come up with. But when you go look at their funds, they have these wide spreads.
Yeah.
And I don't understand
why. They're less liquid. Yeah.
But if you look at Coca-Cola, let's say it's trading at $50 a share, you can sell it at $50.01, and you can buy it for $50. Right. So it's a 1 cent. It's a 1 cent spread, and that's how your ETF should look. But what happens with some of these ETFs is that spread gets 4 cents, 5 cents, 10 cents, and that basically is an extra fee.
Right.
So you buy it, you've lost 10 cents, and then now you have to grow back by 10 cents to get to your break-even line. It's kind of like buying an A-share mutual fund where they charge you 5.25% up front, right?
Yeah.
You got to grow by 5.25 in order to get back to your break-even mark, which is why I don't understand why anybody does that. So with ETFs, if you're at BlackRock, Vanguard, State Street, you really don't have to worry about that.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
It's really not an issue for the large indexes, but if you are trying to get cute and do some targeted exposures or sectors, there could be a little bit of a tracking error. And generally, like, again, S&P 500, maybe like a slight minimal underperformance or overperformance tracking error, but it's really not significant at all.
Yeah, in that one for sure.
Yeah,
and that's the other thing is when you're trading these, tradability. So you've talked about the spread, but also you got to trade some protection. So if you're trading, like for us, if we were trading 100,000 shares of something, we would never do a market order.
Right.
You're going to do a limit order, and you are at 100,000 shares. You're going to call the desk, and they'll just make shares for you. But so that's a bad example. But 10,000 shares, there may not be 10,000 shares available at that particular price. That's the net asset value of the fund.
Yeah.
So you would always want to place a limit order, maybe a penny above what the market price is.
Yeah, and that's something when I'm trading large quantities that I'm looking at, and if it looks like it could potentially move the market, or it's a very large order, I will call the block desk that we work with, and they'll help me place that trade to get the best price.
Yeah, I think it takes 50,000 shares to go right to the authorized participant, and someone will do it 25,000 shares. So there's always ways when we trade as a firm, we're trading all the accounts at one time. And when we do that, that creates some buying power that saves our clients pennies here and there, but those pennies add up to a lot, actually. Okay.
Small wins.
Exactly. So let's talk about some strategies that are used with indexing.
Yeah. I think
first one's my favorite.
Long-term investing.
Yes.
Spoiler alert.
It's the one that wins.
Yeah, I think, we want to be agnostic to market noise and timing, and really the best way to win this game investing in the market is just to stay invested in the long term. I would generally say just be invested over, at least one market cycle. I think on average is about 7 years. But again, just try to, every client situation is different, but when you are investing in the market, just, I would just expect to have that money there for the long term.
It's dollar cost averaging.
Yeah, dollar cost averaging. It's a good way to sort of, I think sometimes clients get bent out of shape about timing the market. It's extremely difficult to time the market. So, a lot of academic research shows that the best way, just to, you should just get market exposure right away. But, a lot of times we could invest at the top or, not invest in the best time. So if you dollar cost average, which means investing, in increments, just say like a third of your capital every 3 months, and then do that for the next 3 months. It's a good way to sort of average your cost basis and kind of have a smoother entry point. Again, over the long run, though, this research that I'm talking about really shows it doesn't make that much of a difference if you are investing in the long term.
Yeah. And that's, people think, I dollar cost average because I invest money with my into my 401k with my paycheck, but actually you're buying at different price points, but you're investing right away. As soon as you get paid, the money gets invested 100%. You didn't have that money prior. Now, if you were given your salary on an annual basis, so you were given your salary in January for the whole year, would you dollar cost average in, or would you invest it all at once? And all the research we've seen points to you just invest it all at once. Yeah. You're losing income, right, from the portfolio by dollar cost averaging. And you're also, people are the worst predictors of which direction the market's moving because it's all based off emotions.
Yeah. And a lot of people get concerned, especially now. I mean, the S&P 500's up, 16+% this year.
Right.
People always get concerned. Well, the market's up a lot. I don't know if I should wait. But But, a lot of this research shows, obviously momentum begets momentum. So when the markets are doing well, they continue to do well. And if you miss, I think, I can't remember the exact numbers, but if you miss the 5 best performing days in any given year, your portfolio greatly suffers. So you don't want to be caught just, on the sidelines, trying to time the market, where you could potentially have, where it could potentially get substantial returns.
Yeah. Using index funds for asset allocation. Can I walk through that?
Yeah, that's something we do at Wiser, but it's really an efficient way to get market exposure at low cost. Really, we want to achieve broad asset class exposures, just to get this exposure to different types of, to different asset classes. And again, this helps build out diversified portfolios to get that optimal risk-adjusted return.
And then obviously rebalancing is a good part of that. A lot of times you hope for this, but stocks are going to outpace bonds over time. So eventually your stocks maybe go from 60% of your portfolio to 65. So you want to take those gains and reinvest them back into the bonds. Right. Or in a down market, bonds should be rising, stocks are falling. So you want to take the bonds gains and buy stocks when they're at depressed prices.
Right.
So the rebalancing is very important, and it can easily be done with using index funds. Tax efficient investing, we've kind of touched on that already. We know the ETFs are a lot more tax efficient, and then you can use the passive funds like we've been talking about, or you could take a more active approach with actively managed ETFs.
Right.
So in the end, who should be using index funds? Everybody.
That's what I wrote down on the sheet. I think everyone. I've been in the industry for a while. I've studied finance frontwards, backwards. It's really hard to beat the market.
This whole idea that these mutual fund managers can outpace the S&P 500, it's ridiculous. I mean, but yeah, we have tons of money still in active mutual funds because we have an industry that refuses to let go of the past, or they're getting kickbacks from American funds or whoever it is. Who's it? Edward Jones.
Commission based, yeah.
Edward Jones got kickbacks. They got big taken out on yachts and everything, and they got caught. And instead of stopping it, they just disclose it now.
Yeah.
So
there's your yacht commission.
Yes, right, exactly. That 5.25%. So it really, if you look inside of your portfolio and you don't see ETFs in there, I would say that you're stuck in the past.
Yeah, I would agree.
Now, that being said, there is some proof behind that, because really we've gone over, is it almost 2 decades now of mutual funds losing assets? Still trillions of dollars there, but they're losing assets to ETFs every single year. So what we're seeing is the mutual fund companies are now creating ETFs and doing the same strategy in the ETFs,
right,
which goes back to our very first point, is you just have to be careful and understand what you're invested in.
Yeah.
If you're looking for a passive ETF, if you're at BlackRock, State Street, Vanguard, I'm not quite sure why you wouldn't be able to use any of those. Right? All right, so let's talk about our approach. So we build models using ETFs, and a lot of times our models have to be reallocated slightly, right, to accommodate something that the client has already that we need to work around. So not every client has the exact same model, but ideally in a perfect world,
right,
that would be great. So let's talk about our process and what are our ETF? How are we utilizing ETFs in our firm?
Yeah, so I mean, we've already sort of talked about it. We are using ETFs to get a desired asset allocation mix. And this is based on academic research. There's a academic component on how we structure our multi-asset portfolios, where we are seeking the optimal risk-adjusted return. And just really to kind of plainly put that is, for just say you have 1 unit of risk, we want to get the most return per that 1 unit of risk. So that's how we are creating our portfolios. And, again, at Wiser, we believe, long-term investing, and not to make too many tactical changes, but, this is something that we are watching day in, day out, reviewing in depth at investment committee level. And there are some times where we will make some allocation changes based on the market environment. We want to make sure that our portfolios are positioned, adequately and correctly. If they're, like, for instance, like Bitcoin, if there's a new up and coming asset class that we're big believers in, we want to make sure that we have a way to capture that.
So I think that there's a core model, which just has basically large cap, small cap, and bonds, and some international. And those are super simple. You can create those at home. We give those to a lot of our flat fee clients.
Right.
It works good, lasts a long time. Not sexy, but does a job. In our strategic models, we're able to use a blend of passive. So a lot of it, S&P 500, because it's really hard to beat the S&P 500, but then also adding some return boosters.
Yeah.
And so for us, we have a technology ETF, focuses purely on mostly software companies. You have an ETF that is kind of on the value side, but it's buying funds that have a lot of free cash flow.
Yeah. No, there's an equity.
It doesn't perform as well when the market's really hot, but when things are moving sideways or down, it tends to have a pretty solid return, because those are more value oriented companies.
Yeah. And again, we're, obviously certain funds may underperform in different market periods. Again, we're focused on the long term, and, this fund that we're talking about, has underperformed lately because large cap growth has just kind of gone up and to the right. As technology and AI stocks have just boomed. But we have a little bit of active exposure in the portfolio, and really, the thesis behind this is there are some areas, especially in different asset classes, like in fixed income, we made an allocation change there to add a little bit of active exposure, because that market and some other markets are not as efficient as U.S. large cap equities, and active ETFs are better equipped to kind of take advantage of these dislocations and fragmented markets. So, we've added some active exposure there as well.
So it's a blend. Mostly it's mostly passive, but there are segments of active management that we've used in our models.
Correct.
And we take, we talk about a lot of things, but we take action very little, just because there's always lots of ideas.
Right.
But then how do you vet those? And you can't be changing portfolios all the time. You're going to, erode return by doing that.
Definitely.
So we've been doing this since 2004. So this is 20 years of building all ETF models. And I would say the portfolios now are more sophisticated than they were in the very beginning, because there's certainly more choices. But I would say that if you have mutual funds, that inside your portfolio, the chances are you're probably in some type of a revenue share relationship. Because a lot of these mutual funds at the brokerage houses are sending 12B1 fees. I call them kickbacks. The SEC calls them 12B1 fees to the advisor and to the company that you're with. So what you want is to strip that out of that relationship and use ETFs. Now we're starting to see that. I've seen Merrill portfolios coming through that have more ETFs in it. They just pay a bigger, they call it a wrap fee, but they pay a bigger fee to use those. So the market is certainly looking more like fee only advisors. We've been using the ETFs for 20 plus years, right?
Right. It's funny. I still know some firms that, while they're, I'd say they're not as commission based, or, the funds that they use, but they still do use a lot of mutual funds in their model construction. And, to our points earlier, it's just really, in this day and age, it's really just an inefficient way to build model portfolios.
I mean, a lot of times we get this legacy mutual fund and we start looking at the costs and go, man, this thing's costing 0.9%. It's spitting off, X amount in capital gains pretty consistently every year. So what we do is add that cost plus the cost of owning the fund and then you subtract that or divide that by the tax liability of selling it and taking capital gains from selling it. And you go, okay, Mr. or Mrs. Client, this is your break even. We can get out of this fund, but it would take 5 years to break even.
Right.
And then you're like, but 3 years or 2 years or 1 year is kind of a no brainer. It's okay. I'm going to take a little bit of a hit, but I'm going to move into something that's way, way cheaper.
Right.
Going forward. And a lot of times, better returns.
Yeah.
Especially in the large cap space. So, but yeah, ETFs are here. They're here to stay. In fact, I would say ETFs, their biggest threat's probably direct indexing, which we also do.
We do.
and that's also leading edge. I mean, think about that.
It is. Yeah.
A lot of firms are not doing direct indexing. I know my peers are not.
Right.
The people that I spend time with that are in our industry, none of them are doing direct indexing. So it's kind of a no brainer.
Yeah, definitely.
It's like a freebie that a lot of people are just missing because their firms aren't connected with the right people to be able to implement that.
Yeah, it's definitely another, I'd say value add to clients. Unlike investing in just a SP 500 large cap ETF, just a quick rundown of direct index, and it's a strategy that that someone provides that uses computer technology to optimize the strategy to an index, and then you're holding, instead of one position, that's an index ETF, you're holding maybe 500 stocks in the SP 500,
right?
And that way you can this is all managed elsewhere, but
it's like a bag of peanuts. The ETF is a bag of peanuts. You own this bag, has all these peanuts in it.
Right.
And what direct indexing is, you don't have the wrapper anymore, but you still have all the peanuts.
That's a good way to put it. Yeah.
so with all those peanuts that are in that bag, some of those peanuts you are able to sell off for a loss.
The ones that have cracked shells.
When they have cracked shells, you can sell them for a loss. Another example is you have 7 stocks last year that pulled up the S&P 500 dramatically. You had 493 that didn't do so hot. Well, you still get the same return as the whole index, but you get to write off the losses. And those capital gains credits will build over time, because the max you can write off is $3,000. We have a whole podcast on this that we can link to in the show notes. But direct indexing, if you have at least $200,000, $250,000 assigned to large cap in your portfolio, and you're in a brokerage account, you don't have a reason to do it in IRAs. Mm-hmm. If you have a brokerage account, then you should be doing a direct index strategy for your large cap allocation.
Yeah, and it all kind of depends on the asset mix. But something, we're going through our client base, and when we see a client that might be a good match for direct indexing, we'll kind of get together as a team and talk about it. And then if we still think it's a good fit, then we'll bring it out to the client.
Yep. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Also note, we have 2 more podcast episodes, 208, 216 on direct indexing, and then what are alternative investments, which we didn't really talk about today. We have a YouTube channel, A Wiser Retirement. 2 videos there. Is it always safe to invest in the S&P 500? And does lump sum investing beat dollar cost averaging? Those are also linked in our show notes. Thanks for listening. If you have a minute, be sure to like us or subscribe to our podcast wherever you're listening to the podcast. Have a great week.